This is Greg Michaelowski, and I'm with FXDD, and I'm doing a Forex commentary for FXStreet.com. We're going to focus on the euro dollar versus US dollar, and as it continues to stay under pressure again. Looking at the daily chart here to start things off from a technical perspective, what do we do? We went below the old low that was reached earlier on June 1st, came in at 121.11. The market moved below that level earlier in trading as some fundamental news out of the Eurozone continued to dominate. Hungary, Prime Minister said they're in a grave situation. We also had talk of Estonia being added into the European currency unit. A report that would happen. Also, banking worries out of the Eurozone also weighing, and the Greek debt and Spanish debt and stock markets getting hit. The Dow is down around 200 points as we speak. And all this is contributing to a flight out of the euro and into the U.S. dollar in particular, and so we are seeing that currency pair being pressured. Now, from a technical basis, again, we do have that 121.11 level that the market would need to have to get above in order to give any sort of positive bias for the euro versus U.S. dollar. And I might also add another level here, and if I take a look at the weekly chart of the euro going back in time, if you take the low for the currency pair that occurred in 2000 and the high, the midpoint of that comes in at 121.31. The market is now below the midpoint of the low to high range for the euro versus US dollar, and given all the problems that the eurozone has, granted the US has its own problems as well, but relatively speaking, the euro at the midpoint of its range may seem to be a little bit dear as far as the price goes. Now, where could the downside take us? And from that perspective, I have a couple lines here in the chart: 119.68, 118.67, 116.36, and then the other Fibonacci level at 112.09 is another possibility. Now, where do these lines come from? And I'm going to zoom in here during this period. The last time the market was down at that area, I'm going to zoom in here, and what we're going to do is go back along this 1968 line, and we're going to see here that the market really based around that area on its move to the upside here, right prior for 2 weeks prior to the move to the upside. So that's a key price. We have a low here at that area. We have a low here at that area. Low here, low here, low here. All at this 1968 area here. You can go back in time, look at this price. This is what I call key remembered price, and that level becomes a level that the market pays attention to. And so I think that when the market, if the market should head further down, we should see support at that 1968 level. Now, the other level that I had was this 1867 level, and you can see here that has a similar type pattern: lows around this area, highs around this area, all around that 1867 level. So that level also becomes a level that the market will likely remember, that will likely come back and revisit if the market continues its trend to the downside. The 1636 level is simply this low price off of this move before the market really started its move to the upside that saw the market go through the 1867 through the 1968 level, and so that becomes another key level. Finally, as I mentioned, the 61.8% retracement of the Euro's range from the low to the high comes in at 112.09. That may be a longer term target and not out of the question for the euro versus US dollar. Now, I'm talking a lot in terms of the bearishness, but what we have to do as a trader is recognize that the market can go either way. It does. These currency pairs are corrective, and there are other things that influence it rather than the fundamentals that I've talked about so far. But from a technical perspective, the bias remains down until that price is able to break above this 121.11 area. Again, that was the low that we saw here on the first of June. The other key level again is the 32 level, 31 level, which is a 50% retracement of the euro's move, and the 43 level, which was the original low that we saw here going back to May 19th. The low came in at 121.43. Until those levels, that is the risk, is that the market goes back above those levels. If the market gets back above those levels, then the bias turns more to the positive side for the euro. But until then, the market is probably going to continue to remain under pressure for the fundamental reasons, and more importantly, in my eyes, from the technical perspective, that is how I am seeing the market. So, with that said, keep the focus on the bearish side from a technical perspective, from a fundamental perspective, and so look for opportunities to sell and stop yourself out if the market should break above those key resistance levels on the top side. This is Greg Michalowski with the Forex look at the euro versus US dollar for FX Street.